So IS 19, the objective of IS 19 is to prescribe the accounting and disclosure for employee benefits, requiring an entity to recognize liability where an employee has provided services. So when an employee provides services, they are entitled to some benefits. So which are these benefits? So we have types of employee benefits. We have what we call short-term benefits. Short-term benefits are those benefits which are expected to be settled within 12 months. Afterwards, what has happened? After the end, this person with the handwriting, after the end of the annual reporting period, during which employee services were done what? Rendered. So those are what we call short-term benefits. Examples. What are the examples of the employee benefits? So examples includes wages, salaries, profit sharing, bonuses, but excludes termination what? Benefits. So salaries, wages, not within 1 year. Profit sharing and bonuses payment costs should only be recognized when an entity has a legal or constructive obligation to make such payments. Not very necessary for us. Then we have post-employment benefits. Post-employment benefits. These are benefits payable to an employee after retirement. Payable to an employee. The entity should have a post-employment benefit plan for its employees, like NSF is just one of them. You can have even Britam, Jubilee, CIC, but now when you have employment benefits like pension, then that is for, with the main purpose of employees getting these benefits after retirement, then that is called post-employment benefits. So we have types of employment benefits. I want you to check for me May 2019, question 3A. Open there, then someone will read for us. May 2019, question 3A. Whoever gets this, tell me the page. Medical cover. Medical cover should just be short term because people are doesn't get any time. But now you see it is going for more than a year. So it cuts across. Both. But now you say in terms of post-employment, it should be purely after retirement. So it will be page 56. Thank you. Page 56. Will you kindly read for us? Yes. Two types of employee works. Of employment? Post-employment, yes. So what you need to know, employment benefits plans, we have two of them. Employment benefit plans, we have two of them. We have, so this is post-employment benefit plans. We have defined contribution plan, and we have defined what? Benefit plans. I'm not going to go there as per the notes. I just want to give you an overview, then it will just concern with the notes. In a defined contribution plan like NSSF is a defined, someone unmute yourself. NSSF is an example of a defined contribution plan. So in a defined contribution plan, the amount you are contributing is what you know. But what you will get in form of benefits will depend on the performance of the economy. Hii NSSF unaweza kaa chini useme tangu nianze kufanya kazi nilikuwa nilikatwa hivi. So when you retire, you go with your list that let's compare. This is what I want. Does it work like that? No. It can either be half, but they normally try to do it. But the amount you are contributing in a so in a defined contribution, you know what to contribute, but what you will receive, you cannot estimate. It will depend on how the economy is performing. In fact, in SSF, they invest in different sectors of the economy, in real estate. But are you aware in Nairobi town, NSSF has so many buildings? Are you aware? These buildings in CBD, most of them belongs to NSSF, so that they get rent from tenants. Then again, they invest in government bonds, so that when people need their money, they don't look as if they're broke. So they will always have cash flow. So they normally invest. But sometimes, like during COVID-19, the performance was not very good. The performance was not very good because when some people closed the offices, they were not able to get the funds and all that. So people who retired during that period, you realize they never got good benefit that time. So in brief, defined contribution, to avoid a lot of stories there, the amount contributable is not. What you will get will depend on the performance of the economy. But in a defined benefit plan, the amount you are contributing is not fixed, but what you will receive is what you know. This person comes and tells you, provided after 10 years, you have invested with us 3 million, we'll be able to give you 3.5. So the 3 million, you arrange yourself. You can pay quarterly, you can pay semi-annually, you can pay daily, depending with how you program yourself. Like insurance, sometimes you can pay in advance, but you see NSSF is a must before not before 9th. That's when you do NSSF. You must file and do what? Pay. So in this one here, what you will receive is what is defined in advance. They tell you in advance what you will receive. But what you contribute, you plan yourself on how you contribute. So those are the two forms of employment benefit plans. A plan, listen to this, a plan is also known as a scheme. A scheme is also known as, just read it, plan, scheme, fund. It's also known as a fund. So in time I talk of the fund, the scheme, the plan, that is one and the same. Allow me to proceed. Measurement. How do we measure them in the financial statement? Net defined benefits, liabilities, or assets requires an application of actuarial valuation. An application of actuarial valuation. Actuarial valuation is the valuation which is carried out by the actuaries. Actuaries are let me say, the people who are employed by these plans to do the estimations. If not all, but some of us, we have seen someone from insurance, they tell you if you contribute this within this, this is what you will get, all those stories. So those figures they are giving you, they are always pre-calculated, and the person who normally do those figures are called actuaries. So the actuary will always carry out a projection. They do a projection that if you do this, this is what you'll be able to get. So the measurements, when you want to measure them in the financial statement, they are always based on the actuarial valuation. Key terminologies. Number one, we have actuarial assumption. It is the amount expected from the actuarial. Yes, makes sense. Actually, no, it is the amount expected from the actuaries, delete that, from the actuaries, the amount expected from the actuaries, estimated value. Actuaries estimated value. So the actuary will always estimate that if you do this is what you will get. Actuarial gain arises when the fair value of the plan asset exceeds the actuarial assumption, or when the present value of plan obligation is less than the actuarial assumption, and vice versa applies to actuarial loss. That is a story. Whatever you are contributing to the scheme, is called plan what? Assets. To maintain your scheme, even those people that use our money, even bank, when you save with the bank, what you have saved is your asset. But bank also sometimes needs ledger fee. Sure, to maintain your account. So the amount which they deduct from your account is called plan what? Obligation. So actually, nobody carries out these two. They tell you that if you contribute this, at the end of the year, your money will be 2 million, for example, and the obligation will be something like 100,000. So actuarial gain arises if the plan asset, the actuary said it will be 2 million, but now the actual outcome in the scheme may be 2.2. Like 2 days or 3 days ago, US reported that the GDP has gone up by 2.9%. So when the GDP of US goes up, of course, we expect everywhere in the world there will be a small increase. So if the increase goes up, even the bond rate, the money markets, the treasury bills, you'll expect a small increase everywhere. So that increase, if NSSF, they are also invested there, then they get good returns. When they get good returns, they will also adjust. Your account with small interest. So when the actual outcome in the scheme, is more than what the actuary was estimating, then we talk of actuarial gain. If the loss, they are expected a loss of 100, then the loss falls to 80. That is also actuarial gain because the loss has gone down. Are we understanding each other? So the variation, what the actuary estimates is called actuarial assumption. If the value, the actual outcome of the asset is more than the assumption of the actuary, we talk of actuarial what? Gain. So again, methods of recognizing actuarial gains and losses. We have two methods. I want you to go and research for me those two methods. Where you get them? We just do on the Google platform. We have what is called projected unit method, the corridor limits method. Check for me that. Number 3, funded and unfunded scheme. A funded scheme is any scheme in which the total value of the assets exceeds the liabilities. So if your savings is more than what Wanakudai, they want you to pay, then we talk of funded scheme. Unfunded is when the liabilities, like there's a day I was very broke, then someone gave me a check. Not all to deposit, and the bank, they were deducting money in my account every now and then. And the negative was running into 10,000. So when I deposited the check was only 12,000. So I expected 12, only to get 1,800. I don't know what else was deducted. Then you say these people are joking with me. They have stolen from me. When you go there, you are shown the ledger fee has been going like this for quite a number of time. We have deduction. So if the liability is more than the asset, because my asset, I anticipated an asset of 12, only to realize my liability is what? 10. But in which case, the asset which was there was more than the liability. Then in that case, you talk of funding. But if the liability could have been more than the asset which you have, then you talk of what? Unfunded scheme. You have retired and you're being told that you will not pay you any pension. You started well with the contribution, then you stopped. We even want you to come and pay some fees which we have been deducted. Current service cost is an amount in which those stories I don't want to read. Current service cost is the amount which the company will incur as a result of services which the employee provided this year. And the most one is the contributions. Employee has worked, please contribute to the employee. So the amount the employer incurs on behalf of the employee as a result of services they have provided, that is called current service what? Costs. Multi-employer benefits. Multi-employer, an employer is contributing for you for retirement, CIC insurance, jubilee insurance, return, where. So if they have more than one scheme for similar employee, then that is called multi-employer. Pension schemes are required. Before we go there, you have written, okay. Pension schemes are required to maintain the following two types of final accounts. So they are required to maintain what is called statement of changes in net assets. So when you find such kind of a question, statement of changes in net assets, that is the P&L, that is the profit and loss account. That is how they call it. Then statement of net assets is the statement of financial position. Full stop. Categories of expenses that should be recognized in the P&L, that is the tax statement. In the P&L, you need to recognize current service cost, past service cost, actuarial loss, interest charged, among others. There's a question they have asked before. No, I think it is in the handout I want to share. I'm sharing with you this handout very fast. Don't want to go there and waste a lot of time. So I'm sharing these handouts so that we can check on it. There are some questions I want us to do there. So check the handout I've shared in the group. And most importantly, when if time is that time bad, can you check number 1 to number 6? 1 to 6, tell me the question which you need me to expound on. Then we go to number 7. Number 7 is computation, which I want us to do. Is there any you want us to expound on before we proceed? Which one? Someone say Mary saying with 4. 4, eh? So where's my phone? Then mine is online. I don't know. So question 4, identify 5 benefits that could accrue to an employee of an organization from their membership in a defined contribution plan instead of a defined benefit plan. 1, you need to ask yourself, what is a defined contribution plan? In a defined contribution plan, the amount you are contributing is what you know. What you will receive will depend on the performance of the economy. So what will be the advantages? Let's have that one written down. Advantages of a defined contribution plan. Advantages of a defined contribution plan. Number one, you know the amount, eh? The amount is known. The problem is what you will receive. So it is easy for planning purposes. True. So you can plan yourself. You know how much you're supposed to. So number 1, enables an entity to plan the expected cash outflow. To plan the expected cash outflow to be contributed to the scheme. To be contributed to the scheme. To be contributed to the scheme. Number 2, an employee benefits from tax deduction. An employee benefits from tax deduction. From tax deduction. And that one you should be aware, e.g. pay. E.g. pay. All of you should know that the amount you contribute for pension, NSSF, normally reduces your tax liability. It reduces the pay as you earn. So what you're supposed to pay KRA is always reduced with what you contribute to NSSF. In fact, accountants, before they tax, they reduce first the NSSF. Is when they tax you there. So there is always that benefit. Number 3, the plan is mobile. The plan is mobile. The plan is mobile, i.e., the employee will continue with the same amount contributed. We continue with the same amount contributed even after changing the employer. Even after changing the employer. Next, it provides funds. It provides funds upon retirement. Those are obvious ones. Upon retirement. And finally, it is equitable. It is equitable. It's equitable since it is based on the gross pay. On the gross pay of an employee. Gross pay of an employee. So it depends on what you want. People don't contribute the same amount. That's what you need to know. Anyway, I know some people in Kenya are still contributing. Employer 200, then employees also how much? 200. This is called old what? Old rates. But ideally, people should use tier 1 and tier what? 2, where anybody earning above 18,000 should be contributing how much? 1080 employer, and also employee should contribute for you how much? 1080. Anyway, we use take those ones. Let's go to number 7. Let's go to number 7. I hope that was the only issue. So number 7. It says, and I read, third advantage. Someone is asking what was the third advantage? Third advantage was the mobile. It's mobile. Mobile. Third advantage was mobility. Mobility means when you shift employment, you don't lose what you have already done what? Contributed. If you shift from here to there, you continue your money. So let's meet in number 7. The following trial balance was extracted from the books of the Woody Retirement Benefit Scheme as at 31st March 2011. So we have accumulated funds, accrued expenses, administrative expenses, demand deposits, then reduction in market value of investment, commutation and lump sum retirement benefits, contributions due within 30 days, employer normal contribution, employer additional contribution, individual transfers from other schemes, individual transfer to other schemes, investment income, investment property, fixed income investment, members normal contribution, members voluntary contributions, pensions paid, equity investment, we have quoted and unquoted. So quoted investment, okay, all investment are assets. Quoted investment are those investments you have in companies which are listed. Listed companies are companies trading in stock market. So like Safaricom is a listed company. So if you have investment in Safaricom, then you call those investment quoted what? Investment. If you have investment here in Destiny, have you ever seen Destiny in stock market? If you have investment in Destiny, then those ones are what? Unquoted. Whether quoted or unquoted, investment relates to their assets. Unpaid benefits, they are required. So you are required to prepare the statement of changes in net assets for the year ended that. Then statement of net assets and that. These two names normally confuse students. Which one is balance sheet and which is which? Because in exam, you know when they are in the form, You just know the first one is P&L and the second one is balance sheet. But in exam, they can only require one. Then you're just remembering that something assets, net assets. Because there is changes in net asset and there is statement of net assets. So what should be your guiding point is the one for the year ended and assets. For the year ended, P&L is the one which is prepared for the year ended. Then balance sheet is prepared. Are we together? Very good. So let's start that one. I hope we can finish. Let's start with the statement of changes in net assets. So right there, Juhudi, retirement. Retirement benefits. You write retirement. Here we're not writing things, we are doing math. Right? Statement of changes in net assets. For the year ended, year ended when? 31st March 2011. So this one is always very easy. You just give us, so let's operate two columns. Shillings are in millions. So bring income. Income, pick from that balance. Income will always appear on the credit side, credits. So check the figures against the writings so that we can know which ones are which ones. So income, we have on the credits, employer normal what? Contribution. So to the scheme, that is an income. So employer normal contribution. Employer normal contribution. That is how much? 15.04. Employer additional contribution. Additional contribution. Employer additional contribution. 320. Then we have individual transfers from other schemes. So transfer from other schemes. Transfer from other schemes. That is 157.5. Investment income. Investment income 2370. Then members normal contribution and voluntary. Bring for me those two. Members normal contribution and members' voluntary contribution. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. 2370. So members' normal contribution, is that what? Start adding for me the totals. This is 912. Then we have members voluntary contribution 228. Give me the total. Yes. 54. Like that. 54. 21.5. Expenditure. Expenditure. Expenditure, pick them on the debit side. Administrative. Accrued expenses are liabilities, so don't ask why I didn't leave it out. Furthermore, expenses are on the debit. So admin expenses, how much is this? 140, 142. Then reduction in market value of investment. How much is this? 11? 1132. Then commutation and lump sum retirement benefits, commutation and lump sum benefits, lump sum benefits. $241. Contributions due within 30 days, no? The 93 transfers to. So transfers to other schemes, transfers to other schemes, 93. Then pensions paid. Pensions paid. Pensions paid. 382. That is all. Can you add? Bring it here, you subtract. What you get, if it is positive, you call it surplus. I don't have a space. You call it surplus. Negative, you call deficit. They don't talk of profit or loss. So call it surplus or deficit. Yes. Where are we? Like, just tell me 1 minute. That's an asset. It's a contribution receivable. Contribution receivable. You know, we are working on the perspective of the plan. Like, if this is an SSF, then we are like preparing the books of the SSF, not of the company. So contributions due are the ones we need to receive from the employers. Are we okay? Yes. So we are getting a surplus. Surplus of how much? 45. Let's go to the other one. So Juhudi, retirement, statement of net assets. So non-current assets. Non-current assets. Let's start from top, bottom. Let's pick them from bottom. I so much are concentrated at the bottom. For bottom, equity investment. Quoted. And we have unquoted. All of them are your assets. 4392. Then 249.5. Check out. Members, no members, no. Fixed income investment. So fixed income investment, 13,180. Investment property. $66.16. I don't see anything else unless there is one you can see. Give me the total. How much? Current assets. It will be 25,187. Okay. Current assets. On the debit, we have demand deposits. So demand deposits, 1173. Have it in the first column. Each other. Contributions due within 30 days. Contributions due within 30 days. That is 247. Can you add? Don't take it. The other side, there is a way they prepare this balance sheet. Bring it here. I'll show you. How much? 1420 less current liabilities. Any organization which pretends, I'm sorry to use that word pretend, but me, I always see it as a pretense. Is there anybody doing something without profit motive? No. And we are just keeping for people money when they retire, we give them. they normally work by subtracting liabilities so that they can check what is called working capital. So if it is weak, the regulators will tell them something should be done. So you subtract the current liabilities here. This other commercial, you just take it here, you say total assets. But with these ones, they don't work that way. Which one? There is one I saw. The first one, the second control. Accrued what? Accrued expenses. Well, then the last one, unpaid. Unpaid benefits, that is a liability. That is 16. So take that minus that minus that. $13.82. Line 2. So total net assets. Total net assets. Total net assets. How much? 26. Huh? 57 points. Then you say financed by. Financed by. Financed by, how did they finance this? Accumulated. Accumulated funds. There was accumulated funds, the first one. So accumulated funds, 23,078. Then surplus for the year. Surplus for the year. The one you got in the other account. That one comes to the ratio of 35, 01.5. There is nothing. Can you check on this balance with the total net assets? It should balance if we are accurate. Is it not? Difference of? Or somebody gave me a wrong answer. 25,187.5. What's the issue? 5? A difference of? Maybe it's a wrong answer which somebody gave and we took. Gideon is saying it is okay. According to Gideon, any other person online, Gideon is saying it is okay. Some people here are saying it is not. Which is which? Even Vera is saying it is okay. Vera, you are adding what and what? Because all people on physical are saying it is not. So how? What is this addition? Joyce, you know your dad gave me this one. So in case somebody copy, who you calculator? So if those who are saying it is agreeing, is there somewhere people never added well? Maybe you tell us very fast instead of us struggling. And you captured it well. Then you are saying now let them struggle. Sikotawa is okay. Well, 23,017 plus 35,01.5 is 26,579. Well, Sikotawa. This group, how are you adding it? Oh, the neighbor said it is not okay. Then you being without no calculator, you said let me also die with not okay. How are you adding? Now, I want you to go and attempt the other question. There were 2, 7 and 8. We have done 7. Go and attempt 8. We shall do it in our next class to confirm. Otherwise, I wish you a good weekend and a prosperous. So tuonane next week. Thank you. We will drop it there.